Hey guys, this is Justin from BreakIntoCRE.com, and in today's video, we're gonna walk step by step through a real estate cash flow statement and what that's going to look like for a commercial real estate deal. So if you're preparing for an upcoming commercial real estate investment interview, or you're just looking to buy your first commercial real estate property and wanna know what to expect, make sure to stick around for this video. Now, if you're new here on this channel, we talk about real estate deal analysis and financial modeling, and also real estate investing careers. So if you haven't already, make sure to hit that subscribe button and hit the notification bell to be notified every time I release a new video. Now, if you're just starting out and trying to break into commercial real estate or real estate private equity or brokerage, you may be wondering what the cash flow statement is actually going to look like on a real estate deal. So by the end of this video, you'll know what a cash flow statement is actually made up of in commercial real estate and what you might expect to see line item by line item. So let's start this out here at the very top of your cash flow statement. And at the very top of your cash flow statement, you'll have gross potential base rent. And what this is telling you is what would that rent be if your property was 100% occupied for that specific period. Now in commercial real estate, obviously this generally isn't the case, and you'll usually have three different things that are going to be subtracted from that gross potential base rent. Now the first is general vacancy loss at the property. And this is just reflecting what the overall vacancy loss amount is for the units or the suites that are not leased during that period. Now the second part of this is credit loss or bad debt. And credit loss or bad debt is just reflecting the uncollectible amounts that you weren't able to collect from your tenants even though they owed you that rental amount contractually. And finally, the third thing that you'll deduct is any sort of free rent offered at the property. So oftentimes landlords will try to entice potential tenants through several months of base rent abatements, and that's going to be reflected here. Now, once you have your net base rental revenue calculated, you'll also have some additional other income line items outside of just the base rent that's owed by your tenants. And on a commercial real estate deal, so retail, office, and industrial, oftentimes the biggest line item here is going to be your expense reimbursements. So I'll link to another video that I made on commercial real estate expense reimbursements down in the description below, but this is where any reimbursements for things like property taxes, insurance, common area maintenance, or any other operating expenses are going to go when tenants reimburse their pro rata share of a certain amount of operating expenses. Now from here, you may also have other income line items like parking income or storage income, and if you're working on a retail property, you may also have something called percentage rent up here in your other income line items. And again, I'll link another video in the description below that talks all about what percentage rent is and how you can calculate it. Now from here, once you add up all of your base rent and your other income line items at the property, you'll have your effective gross revenue at the deal. And from here, we're ready to move on to the second part of our cash flow statement, which is going to be our operating expenses. Now our operating expenses are going to be the ordinary operating expenses associated with operating the property on a day-to-day and month-to-month basis. So again, this is going to include things like property taxes, insurance, any sort of repairs and maintenance, property management fees, and any other regular recurring expenses that you may have at the deal. Now once these are all added up and you have your total operating expenses at the property, then you can take your effective gross revenue and subtract your total operating expenses to get your total net operating income at the property. Now this is going to be a really important number that's often going to be used by investors to value the property and also by lenders to decide how much they actually want to lend on the deal. So once you have your net operating income in place, then from there, you're going to move on to what are called below the line items. So the first below the line items that you're going to have are your capital expenses. So this will include one-time or non-recurring expenses that are going to be spent at your property. So this would include things like construction costs or renovation costs, and also TI or tenant improvement allowances and leasing commissions as well. Now within your capital expenses, you'll also have something called a capital expense reserve, which is just going to be a monthly amount set aside for future capital expenses that you may have at the property. Now at this point, when you take your net operating income and subtract your capital expenses, you have your cash flow before debt service. And if you don't put any debt on the property, this is all you need. However, in most commercial real estate deals, there's going to be some sort of a loan on that property. So from here, you'll need to add your total debt service on the deal. Now you can show this as one total payment, or if you want to show additional detail, oftentimes the principal payment portion and the interest payment portion will be shown separately. This way, if you're trying to calculate what your total taxable income is, or if you're trying to calculate how much in principal payments you've actually paid over the life of the loan, you can easily reference this to figure this out. So from there, when you take your cash flow before debt service and then you subtract your total debt service on the deal, you get your cash flow after debt service, and at that point, you have your complete commercial real estate cash flow statement. Now, this is really helpful when you're looking through income statements that a seller is providing, or when you're building a real estate financial model from scratch in order to analyze potential real estate investment opportunities. Now, if you want to learn more about how to actually go about doing that, check out my free real estate financial modeling crash course. You can grab that in the link in the description below. And if you want to go all in on this and really master real estate financial modeling and analysis, check out Break Into CRE Academy, where you'll get access to all of my courses, all of my models, and some additional one-on-one support as well. So if you like this video and want to see more content like this, make sure to let me know by hitting that like button, subscribing to the channel, and sharing this with anyone else who might find this helpful. Thanks so much for watching, and I'll see you in the next video.